chasing them. We will be chasing.
I expect he's busy with something, like happens between 9 and 10 sometimes.
Ralph, are you not chairing this next year?
Okay, we are live now, so we'll go into the meeting. Thank you everyone for attending the Pensions Committee meeting on the 26th of March. I have an announcement, which is our usual one, regarding the COVID-19 attendance. Due to the coronavirus pandemic, the Council will be holding this meeting electronically in accordance with the relevant regulations. Members of the public may also attend this meeting in an electronic capacity, and there is a link on the Council's website for them to do so. Members of the Council are asked to keep their microphones switched off until called to speak, and to switch their microphones off once they have finished speaking. Cameras may be left on throughout the meeting if members wish. If you experience connection or other technical issues, it may help to switch the camera off. Cameras should be switched on if and when speaking in the meeting. To indicate a wish to speak, members should use the raise hand function. Use of the meeting chat function is expressly used for voting. At the end of the debate on each item of business, there will be a vote. Members should vote using the meeting chat function by indicating for, against, or abstain. I will declare the result after each vote. Breaks will be taken during the process, and if I allow it to go on too long, perhaps members would suggest that a break is appropriate as and when. I haven't been known to miss the break interludes. I'm going to introduce the members of the committee this morning, and if you just switch your microphone on, switch your camera on, and introduce yourself. Stephen Bolton first.
Hello, good morning. Stephen Bolton, the member for Hatfield Rural.
Bob Deering.
Hello, I'm Bob Deering. I'm the member for Hertford St Andrews Division.
Stephen Drury.
Yes, good morning. For some reason, I'm now called Sandy, but I still represent Croxley Green at this particular moment in time. Thank you.
Very good. At least in our parish council, and we don't go into that sort of thing nowadays. Margaret Emerson Eames Peterson. I get it right this time.
It's Eames Peterson.
Eames Peterson.
You only had 2 years. Yeah, no, I'm Margaret Eames Peterson. I'm member for Hatfield North Division, and I'm the Labour rep on the working group and on the pension committee. Thank you.
John Graham.
Good morning, John Graham. I'm the county councillor for Potters Bar East.
Adam Mitchell.
Hello, I'm Adam Mitchell. I'm member for Broadwater and Stevenage, and I'm deputy chair.
Robin Parker.
Yeah, morning. Robin Parker, county councillor for Chells Division in Stevenage, and I'm the Lib Dem rep on the working party of this pensions committee.
Seamus Quilty. No Seamus at the moment. Okay, he did have problems last time. I'm not sure his problems have been resolved. Ralph Sangster, that's me. I'm the chairman of the committee. And last but not least, I think Richard Smith.
Good morning, Richard Smith. I represent the Welwyn division of the county council.
Thank you. I believe we have Paul Mason, who's a non-voting member, here with us today. Apologies from Joan Lloyd and Stephen Malkovitz. You can probably gather there's a little bit of relaxation in the group today. This is the last meeting of the council, of the committee for this term before the elections. But there's some very serious and particularly difficult concepts to grasp for the members today. So we probably need to take a little bit of time on some of those more difficult ones to make sure that everybody is fully conversant with what the proposals are, and we make sure that everyone is happy with making the proposals. So moving on, declaration of interest. Is anybody wish to make a declaration of interest in regard to any of the items on the agenda this morning? I don't see anybody. So I'll move on. Minutes of the last meeting, part one. Does anybody have any issues regarding the minutes, or can we take them as a fair representation of last meeting? Again, don't see anybody, so I will sign those as and when I finally get back into the to County Hall. Okay, so we're going to start with the asset rebalancing review. And Patrick, I think you're going to take this one initially.
Yes, thank you, Chairman. Members will be aware that we have agreed, you have agreed as a committee back in November 2018 to annually review the strategic asset allocations within the fund and to rebalance the fund if some of those asset allocations have gone outside their strategic targets. It was last reviewed on the 3rd of March 2020, and we did say that we would review it at the first meeting of the calendar year. Unfortunately, this is a second one, but due to the volume of business on the meeting earlier this month, we've had to defer this to later for today's agenda. So the paper, which I'll ask Peter to introduce, sets out where we are at the moment with regard to the strategic asset allocations, and there are some recommendations. Members will also recollect that back at the committee meeting in November, we did agree to disinvest from the Baillie Gifford Long-Term Global Growth Fund because it had gone quite substantially away from its strategic asset allocation. You'll also note here that there is another recommendation to move further funds away from this particular manager, and Peter will explain the rationale behind that. I'll hand over to Peter and ask him to introduce his paper.
Thanks, Patrick. Morning, everybody. Yes, so I won't share our paper or go through it. I'll just talk through the main points, but our paper is on page 15 onwards of the public agenda pack, if you'd like to refer to it. So this is an exercise we go through every year, as Patrick has said. We go through a process where we set our strategic asset allocation, i.e. we want to hold 33% in global equity, 30% in bonds, etc., and then we obviously go and invest some money with some asset managers in those asset classes. Now, obviously, as different asset classes and different managers perform differently over time, the actual holding we have in each of those asset classes and with each of those managers diverges from that target. So what we want to do is periodically review things and bring it back into line. We want to balance doing that because we want to be close to our target versus the cost of doing that. We don't want to be trading all the time because it has cost implications. So what we've seen is that equity markets have performed really very strongly. So the equity allocation has gone overweight quite materially, which is actually good news, because it's given quite a lot of growth to the fund and increased the asset value, so that's all good. So what we would ordinarily do is look to trim that back and use the proceeds of that overweight to boost the underweights, i.e. the other areas of the portfolio, so the bonds and the alternatives. Now, aligned to kind of Patrick's comment that this didn't come to the previous meeting because there's been a lot of work on the agenda, all that work has meant there's an awful lot of implementation that we're currently going through, i.e. making changes to the underlying portfolio, which makes the rebalancing piece now a little bit tricky, because we want to tie up those transactions into things like multi-asset credit, into things like our commitments to the private equity portfolio. We want to time all those things together. There's also another aspect here in that we have an equity protection strategy in place, which reduces our equity risk. We'll talk about that later on in the private part of the meeting. But what that means is that we're slightly more comfortable running this overweight, i.e. having more assets than we're targeting in equity for a period of time, because that fundamental risk is being controlled to the kind of global equity as an asset class. What the fund is exposed to, however, is particular managers being overweight, particularly Baillie Gifford, whose performance has been exceptionally strong over the last year, which has driven quite material growth to the point where they are overweight their benchmark by nearly 4%, even after we trimmed them back quite materially at the back end of last year. So on page 17, the table, page 17 of the agenda pack, the table at the top there, you'll see Baillie Gifford Global Equity as 3.9% over the benchmark. What that leads to is a bit more risk in terms of active risk, because Baillie Gifford are an active manager. So they will have performance deviations versus the benchmark. They've delivered exceptionally strong returns. You would expect those returns to fall back into something being classed as slightly more normal, I guess, i.e. fall back a little bit. So there's quite strong rationale to trim Baillie Gifford further. We're talking about halfway back towards the benchmark, so back towards 6% of the total fund, which means 110 million being taken from Baillie Gifford at the current point in time. In terms of where to place that money, that 110 million pounds that would take out of Baillie Gifford, we're asking for an open delegation for Patrick and the team to go and invest that money in the right area as we make the other strategic changes, i.e. as multi-asset credit comes through and the fund has been set up, as those drawdowns into some of the illiquids are called, and various other pieces as well that are coming through in terms of the evolution of the equity protection that again we'll talk about later. So just having that open mandate to reduce the allocation to Baillie Gifford back to 6% and use those proceeds for efficient portfolio management for all the other strategic changes that we've been working through over the last 6 months or so. I will stop there and take any questions. I think you're on mute, Ralph.
Apologies, I'm not usually putting myself on mute, so I'm not used to putting myself back online again. Anyone with any questions? I don't. Let me see a question there. Yes, Bob Deering.
Thank you, Ralph. Thank you, Peter. Do you mind if I just ask the obvious, really amateur question, just to test the point? I think what some people might say about this is that we're taking a fund that's doing really well, surging, and then we're cutting it back. And the amateur would say that seems to be completely the wrong thing to do, that you should just let the surge carry on and not kind of penalise people for success. Now, I do follow the logic of your advice, but I just think that question ought to be asked and ought to be answered, please.
Yeah, it's a fair question. What we would expect is that manager has produced returns because of a very particular market dynamic, i.e. they are invested in tech stocks that have done very, very well over 2020 and the COVID regime, and we wouldn't expect that outperformance to continue. Now, if we think kind of strategically of active managers, we hope that an active manager will produce a return of benchmark plus 2 to 3% over the long term, but that will be quite cyclical. There will be some years where they will outperform and generate plus 4%, some years where they will underperform, so that on average you will get that plus 2 to 3%. So that if you trim them after they've had a strong year and they mean revert back to that average level of outperformance, then you will get a better investment outcome. That's the return point. The risk point is obviously if they then fall back and you're overweight, then you will underperform more. Now, you're right, the amateur would say, let's run with momentum. The professional, the kind of well-educated investor, I would say, would have stronger discipline and take that emotional reaction out of it and say, you cut your outperformers. If you have conviction in your underperformers, you top up your underperformers in the expectations that things will revert back to something more normal, and that exercise will give you a better investment outcome.
Thank you. Thank you. Very skillful way of saying in passing that you're a professional investor. Thank you.
Any other questions? I don't see anyone with any hands up. The recommendation under item 2 are threefold. One, that we trim back the Baillie Gifford position to 6%, and that we use the proceeds or provide the proposed proceeds for investment into the remaining elements of the fund restructuring, and the decision agreed on 3.11 and 3.12 are implemented by fund officers. Can I ask you if you would indicate in the chat line if you agree, please? Just awaiting confirmation that that's been agreed. Thank you, just received that. So we'll move on to, thank you all for your agreement to that. Item 3, Hertfordshire County Council's Pension Fund Task Force on Climate-Related Financial Disclosures. Patrick, I think you're going to be just tipping this one off and passing over to Mercer.
Yes, that's correct. Members of the committee, you'll recollect that there was a paper presented to you on the 5th of March, your last meeting, on responsible investment. It was more of a briefing note from Mercer's, giving you a context around general matters that have been in the press, ministerial comments with regard to carbon disinvestment, and there was a particular reference to reporting on climate-related financial disclosures, and this report provides some more detail about that and explains the framework and the requirements of what a fund will need to do in the future. Just to be clear, there is no requirement at the moment for the LGPS, such as a fund such as the Hertfordshire Fund, to comply, but we are quite clear that, and we've been told that there will be a requirement at some point in the future. It will be put into legislation that we will need to do this. What this actual paper from Mercer's does is gives you some background as to what the requirements are. The Hertfordshire Fund is in a good place at the moment because we're doing some of this. And one of the recommendations in the report asks officers to have further discussions with Mercer to undertake a gap analysis to show where the fund is maybe non-compliant areas that we would need to work towards meeting that requirement. And we can do this over the next 12 months through the new working group when that's put into place. But I'll hand over to Peter and he can talk a bit further about the requirements.
Brilliant, thanks. So I will share this one so we can talk through it. So hopefully you can see that on the screen. So yep. This is, and this paper we've got here from us is a general tee up about what comes next and an introduction into this framework that is the Task Force on Climate-Related Financial Disclosures, which doesn't roll off the tongue, but is shortened to TCFD, which is what I will refer to it as. And it is a reporting framework, obviously related to climate change, that is cross economy. It started off in the corporate sector, it moved to asset managers, it moved to pension funds, but it is a framework that is going to be consistent across all financial institutions and large companies to drive some consistency. Like Patrick said, it's not currently in the pipeline as a regulatory requirement for the LGPS. It is going to be a regulatory requirement for private sector funds because you fall under a slightly different regulatory framework. My expectation would be that this will come online as a requirement for LGPS funds. Now, unlike some regulatory frameworks that you just have to get on with and do, I think this should be a very useful, a very productive framework to follow to help formalise a lot of the good work that's already been done by the working group and the pensions committee and officers around climate change integration and climate change risk into the portfolio of the Hertfordshire Pension Fund. But what I think is worth doing is going through and just having a look and as Patrick said, doing a little bit more work to find out what the fund needs to do to bring all those things that we've been doing and all those good things we've been talking about and the actions we've been taking together to be able to comply with this TCFD framework. And I think that's worth doing before it's a regulatory requirement because it just reduces the time burden and therefore the cost on the officer group and obviously your use of external advisors to be able to do that, and also help just formalise a lot of the things that have already been made. All the work that's already been done. So you can see, I mean, you can see the soundbite thing on the screen there from Mark Carney, can't self-isolate from climate change. I'm very aware that there is no need to kind of talk through climate change being a risk to the fund and an investment risk, and a responsible investor longer term will be a better investor. We've done a lot of work around beliefs, around policy, to really align that ambition to integrate ESG, environmental, social and governance considerations into our investment thinking, as well as particularly having a good drill down on climate change. So we've done all that work. It's just a case of formalising it through this framework. So it's worth just kind of going back quickly as to some of the what and the why in terms of climate change and some of the time horizons and why now. Yeah, climate change is happening. The physical manifestation is coming through and is happening. How that impacts, the timing of how that impacts companies, societies, how we live, etc., is unknown. You would expect that to be a gradual change over time, so that it is the longer term when you get the physical risks coming through, i.e. rising sea levels, droughts, etc., that really impact communities. And that's when you will get an asset price change in companies, because they will adapt or not adapt, and the winners will win and the ones that don't adapt will lose, which is this climate change zone that we're talking about, sort of 2050 onwards. I mean, like I say, it's a bit of a grey area because we're seeing some of that physical manifestation now, but if nothing is done, then we'd expect that to accelerate. Where we will see asset price risk from climate change in the much shorter term, and probably a much starker change in the shorter term, is what we've called the investor zone, which is effectively the policy implementation to help control climate change risk. We've obviously seen UK government talk about targeting net carbon neutral. We've seen decisions made by companies, so the likes of BP, on linking exec pay to various factors. The decisions made by some auto companies, so Volvo saying they're not going to make internal combustion engine cars from 2030, I think, in any form. So that policy decision will really impact companies that we invest in, i.e. the value of the fund and the returns that we get in the shorter term. So what we want to do is make sure that we're controlling this risk now, even though the physical manifestation will come further down the line, hopefully won't come further down the line because of the changes that everyone makes to reduce the impact of climate change. But the policy impact is very real and something we want to control the risk of. So just from your point of view, the why, the regulation piece is obvious through this TCFD framework. The reputation, the member expectations we know about, you will know about far more than I, being closer to the electorate and the ops as well in terms of some of the requests that come through. But for us as an investment advisor, one of the key pieces around risk management. And it comes back to some of these beliefs conversations that we've had in the past, that climate change risk and broader ESG risks are aligned with pure traditional investment risks, i.e. equity risk, credit risk, inflationary risk, all those big things that we spend a lot of time thinking about. Climate change risk, particularly from this policy point in the shorter term, is a risk to the fund. And when we think about risk, we think about downside risk naturally, I think, i.e. things going wrong. But it also creates opportunities, upside risk. You get this right, you target the companies that are on a pathway to change, a pathway to this green economy, then they will be winners out of this, and it will generate some upside potential as well as avoiding some downside potential. So four areas where this really matters. Like I say, I know we've talked about this an awful lot in the past, and as a committee very much aligned with this thinking and why we want to do this, but just worth a quick reminder. So next page is the regulatory framework that's up and running or has been suggested for private sector funds. So as if you were a private sector fund at the size that you sit at, so over 5 billion, then there would be a requirement for you to put a report in this year. Like I said, that's not come through yet for the LGPS. I would expect it would. Now, if we think about October 2021,
not running out of the fucking car.
I think microphones should be turned off, please.
October 2021 would feel quite tight if MHCLG were to come and say we're going to align the LGPS with the private sector in terms of that requirement from 7 months after October 2021, they might do it, which is why we want to be ready. I would expect it to follow very soon after, though, even if it's not quite aligned. So, like I say, it will come, and it will come quite quickly for the Hertfordshire Fund, just given your size. So what's it all about? The next 2 slides very quickly, and this is really just an introduction about what it's about. And it really is about having a consistent way of thinking and measuring about things, and a consistent way of thinking about risk of climate change across economy. Now, there is quite a lot of work to translate. If you look at the regs and the wording in the regs, then there is quite a bit of work to translate some of the speak away from kind of corporate speak and translate it into pension fund speak, which is the work that's going on at the moment that we're doing with some of our funds. But it does stack up for everybody with some tweaks. And it's around governance, it's around strategy. So we think about investment strategy, around risk management that we talk an awful lot about, because, like I say, we want to avoid some of the downside risks and look at some of the opportunities. And then what are the metrics? How do we measure this thing? And what targets do we set? And we've talked an awful lot about data when we've talked about climate change in the past. The prevalence of being able to measure carbon intensity coming through that you weren't able to do 3-5 years ago. Hopefully, that will accelerate that change in terms of more data points becoming available, because there is this consistent approach across economy, which should give us, as decision makers, as asset owners for the Hertfordshire Fund, more data points to be able to have a much more what's the right word? A much more targeted approach to climate change, i.e. move away from the broad brush approaches that were adopted 5 years ago into a much more refined, engaged approach with companies, and really focusing on that pathway to carbon neutrality and that pathway to the green economy, rather than treating all firms in a certain sector in the same way, because there will be dispersion and divergence and dislocation in sectors where you will get good companies and you will get bad companies. And this framework should allow us to pick between those different companies to get a better outcome. So final slide, just a few bullet points about what each of those 4 pillars might mean in practice for a pension fund and for an LGPS fund. And the governance piece around reviewing climate related beliefs and prioritising actions and what we actually do about it and who does what. And this comes to the fact that all these, the points under governance there are all the things that we've already been talking about over the last 18 months and doing an awful lot of work on. So a lot of the underlying work is there. It just hasn't been kind of formalised in one place and under this regulatory reporting framework. Strategy, some little bits, this is where there might be a little bit more work in terms of scenario analysis and thinking about what the impact, trying to quantify the financial impact of climate change risk on portfolios and how we reduce some of that. So that'll be a little bit of work that we'll need to do. Comment there, understanding the sponsor's exposure. This is about the council's approach and members' expectations. Now, what I would say is that the council, you can have the same beliefs between 2 parties over the same thing and implement it in different ways because you have different objectives and you go about things in a different way. As a large multinational investor with a very long time horizon, you have different financial objectives from the county council. So you may implement the same climate change belief and the same requirement to take action over climate change in a very different way because of those structural differences in how you hold money and your financial objectives. Risk management there, again, a lot of the things that we're already doing. So it is on the risk register. There is a lot of engagement with asset managers, particularly through Access. We do it as well through our ESG ratings that you see on a quarterly basis. We start thinking about things when we make asset allocation decisions. We do have the UBS climate aware exposure in the passive portfolio. So we are taking specific portfolio actions in there to help control some of this risk. And on the metrics and targets as well, but obviously we go through this fairly regular exercise of measuring carbon intensity of the portfolio, really thinking about how we're reducing our carbon intensity to reduce some of that climate change risk. No target set as of yet. You need to be very, very careful with targets because things are moving and evolving at a fast pace. Like I said, the data points or the things that you're able to measure have changed materially over the last few years. That change will continue. What you don't want to do is tie yourself to a target and that target become outdated because there's something better that comes along later. So it's fine to set targets, but you need to make sure that they are measured and they are flexible enough to be able to evolve as the world evolves and as thinking evolves there. So bit of a whistle-stop tour. A lot of the points on the screen there in terms of the requirements, like I say, are things that we are already doing and we spent a lot of time thinking about and thinking very deliberately about over the last 18 months ago. I'm hoping this TCFD reporting framework will be a positive piece of work to help bring all those things together in a single document and a single approach to really evidence all the good work that the committee's been doing and plot a path for where we go next. So whistle stop tour, we'll keep coming back with this. Like I say, as Patrick said, if we do this gap analysis probably at the next meeting to see where do we need to focus our attention. But with that, I will stop and take any questions or comments.
Thank you, Peter. Robin, you have a question?
Yes, thanks, Chair. On this reporting, can Peter just clarify, as I understand it, this already applies in the private sector. Did you have to put in, Peter, on when this will be applied by the authorities, by the government on the LGPS? You know, roughly how long have we got?
Yeah, so it's not currently a requirement for private sector funds. It is a requirement, but it's a requirement for 2021 or 2022 onwards. So it's coming down. It's been set. No word, as far as I'm aware, yet from MHCLG kind of sets these regs for the LGPSs when that comes through. I would expect it to be, if not in line with private sector requirements, i.e. next year, then pretty soon afterwards. So we're talking about 12, 15 months, something like that.
Right, so if that timescale turns out to be correct, the work we're going to authorise today will be done and dusted by the time the regulations come in. Would that be a fair thing to say?
That's the expectation, yes, with the view that we don't want to, you don't want to leave these things to the last minute because then it becomes a much more costly and less effective exercise to go through. What we want to do and what we see this framework as being a really positive thing to help formalise a lot of the things that we do. So we have gone through a lot of the steps already as best practice because the Hertfordshire Fund does follow best practice, and it's just filling in the gaps. And if we do that now, then it becomes positive and it becomes a less of a time burden on officers, which has reduced cost implications as well. So a win-win.
Yes, thank you. I'm in favour of doing the gap analysis, but thank you for that clarification, Peter.
Margaret, do you have a question?
Yes. Thank you, Chair. Can you hear me?
Yes.
Just looking at that last slide, I wanted to know three things really. The TCFD, is that going to change the metrics that we have been looking at? We've been looking at two major metrics for measuring carbon footprint, really. Do you think they are going to change in the next year?
No.
Okay, so we're still sort of measuring by the same yardstick.
Yeah. We have been following best practice in terms of measurement already, and that will be the metric or one of the metrics that we use. Now things will change and we will want to change with them, but at the moment we're doing all the right things.
Yeah, I mean, in the corporate bond portfolio, that's quite tricky because it gets a bit sort of fuzzy.
Yeah,
and it would be quite good to be more precise about which company does what and trying to target them, I suppose. And in that in mind, when you talked about risk management and the annual review of investment managers and your Mercer manager ratings, I was just thinking, do we have to do that review at the same time as every other bit of, obviously we do annually review, don't we, our asset managers anyway, and climate change could be lost in the midst of the rest of the things we review them for. I mean, are we allowed to sort of dislodge the timing for this review so that it is an annual review, but we actually are able to focus more on climate change so that they are aware how interested we are in it.
Yeah, so I think there's 2 points there. So even as an annual review, then we review our managers through the quarterly monitoring, through our managers' research, through the work that the Access Group does on a more frequent basis. In terms of climate change risk, ESG risks generally, an integration of ESG thinking into investment managers. Look, you delegate an awful lot of decisions to investment managers, which is why you set up policies and beliefs and say to managers, go and implement that, go and pick the right stocks to reflect what we want. So holding them to account is obviously an important piece of work. What we want to do and what we do and what Access do as well is not leave ESG considerations to the final question we ask investment managers, i.e. the bit on the end that they just wheel someone in to speak about. It is a fundamental aligned investment risk, as is other major risks that we want to think about at the same time. We want to make sure that climate change risk and ESG risk is embedded in our thinking, but we also want to make sure that that's not the only thing they are thinking about, because there are other important risks to think about when building portfolios, and it's not just about ESG. So it ranks up there, but we don't want to focus on one particular thing, because when you do that, you miss the unintended consequence and the elephant in the room somewhere else, and you want to think about everything together.
Okay, thank you.
Stephen Bolton.
Thank you. I'm just thinking about that there may be with corporates in the future a sort of hierarchy of excellence on climate change matters. And firstly, will there be enough sort of grade one excellent corporates to invest in, bearing in mind that investors around the world will be wanting to do this? And secondly, if that is not the case, will the price, the share price, if you like, of some corporates be artificially inflated because of their excellence in climate change matters over and above their performance financially?
A good question, and it's I guess you could say the same thing at the moment in terms of when you look at stock pricing that ignores the ESG risks, and you get that flood of money into the big tech firms that maybe don't financially support the share price because everyone's rushing money in there. Is that a bubble? Is that too high? Very difficult question to answer, and something that you need to take a view on. What I think what it comes down to is making sure that we are spreading risk and return factors across different sectors, different geographies, to make sure that we're not beholden to just thinking about one metric and chasing one particular thing which will lead to a bubble, to make sure that we are getting that diversification. But fundamentally, you target the companies that you think will do well on an RI risk factor, then they should be more sustainable and better companies going forward. So they will have a higher stock price, but that stock price will be more sustainable. So, you know, just because something is cheap doesn't mean it's good value. Just because something's expensive doesn't mean it's overpriced. That kind of argument. The trick is obviously to kind of wheedle out those stocks that have just generated an increase in price off the back of somebody else, and it's not sustainable. And that's obviously what you employ your asset managers for, and why we need to do this really intensive monitoring on quite consistent basis to hold them to account.
Okay, thank you.
Peter, just a quick question from me. Given that we are being asked or potentially asked by regulators to monitor and report certain issues in relation to climate change and other ESG issues, is there a comparable requirement for companies to start publishing information that would allow us to do so?
Yeah, absolutely. And I think that the fact that this is a consistent framework across economy is helpful in doing that, because everyone has to report on a consistent basis. What you find is when you get some very specific pension fund regulation coming through, so we think about cost transparency and things like that, there is a huge divergence in the way different people report. And because it hasn't got critical mass to align everybody, then it's a really tricky job to source data. My hope and my expectation would be a consistent approach, not just in the UK, but cross geography, hopefully, will lead to easy reporting, which makes more effective decision making. It will take time, obviously, but we need to get on that path to be able to do it.
Okay, thank you. I don't see any other questions, so I'm going to return to the order paper. Under item 3, there are 2 recommendations. 3.1, that the Pension Committee notes the content of the attached Mercer briefing and the good work done to date by the fund. I agree with that. In reporting is its carbon footprint. That the Pension Committee commissions Mercer to undertake a gap analysis for the fund in meeting the requirements of the Task Force on Climate-Related Financial Disclosures. Could you indicate in your chat function, please, if you agree with those 2 recommendations? I'll just await confirmation that we have all the necessary approvals. And we have, so I will now move on to the next item, which is item 4, alternative investment strategies. And I think Patrick is going to introduce this one.
Yes, thank you, Chairman. I will introduce this and then hand over to Catherine McFadden, who's our partner from Hyman's, our lead partner from Hyman's, and she will talk to you about the concept of what we're putting before you, which is alternative investment strategies for employer bodies with different funding levels, and we'll explain the rationale why this proposal is being put forward to you and the modelling that will be done over the next couple of months. This is more about socialising the concept with members of the committee to get your views on what we're proposing. To give you some background to this, at the last valuation of the fund, which was in 2019, we introduced a concept, or the actuary and officers introduced a concept called HEAT, which is Hyman's Employment Asset Tracker, and the committee at its meeting in July 2018 approved the use of this tracker. And what HEAT allows the fund to do is allocate assets to each employer and track them, knowing their inflows and outflows of cash, so contributions paid in and pensions paid out, and also taking into account the asset returns. It's a more accurate way of assessing an individual employer's funding position, and it's a bit like a bank account in really in that you have an opening balance and a closing balance after all the ins and outs that take place. An additional benefit of HEAT, when we introduce HEAT, it does bring additional benefits besides being able to accurately establish the funding position of an employer. It also allows the fund to introduce alternative investment strategies for pools of employers with different funding levels. So in Catherine's presentation, she will talk about the fund, albeit we have 105% funding level at the moment. That's at a whole funding level, but all the individual employers within the fund, and there's over 300 of them, will have different funding levels. Some of them will have weaker funding levels. Some of them will have funding levels which are greater than 105%. So what this proposal, this concept we're floating with you today, is setting out what we should do regarding asset allocation and investment strategies in particular that meet the needs of those weaker, say, employers that have lower funding levels. Should they be in a more defensive strategy? Well, no, they shouldn't. They need to have growth assets, so we need to put them into a sort of growth strategy. To be clear, what we are saying here is we're not going to change the overall funding strategy of the fund. We are going to propose implementing sort of a notional strategy so that we can move assets around to meet the requirements of those employers. We will, subject to the views of the committee this morning, socialise this with the employer groups after we've done the modelling, explain to them why we're putting them into certain buckets. You're going to go into a growth strategy because you've got a weaker funding level, and come back hopefully to committee in November once we've done that sort of discussions with the employer bodies and getting their views on the proposals. That's all I was going to say. I was going to hand over to Catherine to go into some of the detail.
Good morning, everybody. Thanks for that, Patrick. Patrick's actually done a really brilliant job of introducing that there and covered a lot of the content that I would cover. I will share some slides and go through the presentation. Hopefully you're seeing them on screen now.
Yes.
Perfect. Okay, so let me flick down to the next one. So Patrick's really teed that up beautifully and explained why we're looking at the additional investment strategies. And really, it comes down to the fact that the employers in the LGPS and the Hertfordshire Fund in particular are a really diverse group. What this slide there shows is some of the ways in which employers are different from each other. And so I'll just highlight a few of the key ones. Some employers in the fund are in the fund for the duration, so they have no choice really, and they're going to participate in Hertfordshire Pension Fund as long as they as an organisation persist. Some other employers only participate in the fund for a very short time, and then they are looking to exit the fund at a clean date. And when you look at those two different types of employer, that really does drive quite a different attitude towards the pension fund. So those are some of the variations there. If I flick down to the next slide, this is summarising some of the employer diversity that we saw at the last formal funding valuation, as Patrick talked about in 2019. That blue, the blue on the top left, all the blue lines show the range of different funding levels we had for employers within the fund. Now, some of these employers are very, very tiny, so they don't actually make much of a difference in the overall funding level, but you can see there the huge range of funding levels that we had for different employers in the fund. Another really important difference between different employers are their cash flow profiles. We have different employers at different stages of evolution really in their pension journey. So we have some employers who maybe only at this point have actives. Now, academies might be a good example of that. They're relatively new as an employer in the fund. They've not been in the fund long enough to have a significant number of members retire and to be paying pensions. So their cash flow profile is very, very different. Just now they're very cash flow positive in that they're paying lots of money into the fund but not getting any out at this point. Whereas other employers might be at the other end of that journey. They might be maybe only have one or two actives left, closed to new entrants, so they're not getting any more in. And their cash flows are all very much about paying the pensions out. So they've got a very different cash flow profile. And this is all quite important because it changes how these employers' funding progresses in different conditions. Patrick mentioned socialising this idea with employers, and we will absolutely have to go through that process. In some funds who've already looked at this type of exercise, some of the impetus for looking at it actually comes from employers and some of the discussions that we have with employers through the formal valuation process. And you can see there some of the questions that we get asked, why is my pension deficit so volatile? That for some types of employers, that's a real problem because it comes through in their accounts at the end of the year and it causes difficulties with them in terms of their own business planning, business management, difficulty raising funds because their funding level is so volatile. For the council, for example, the funding level being volatile isn't a big issue because we know we're in it for the long term. So you see there's some of the types of questions that we get asked by employers, and some of them do reflect that for some employers they're possibly not in an investment strategy that best suits their needs. I'll fleech down a wee bit, just make sure we can see this. And again, this is just another summary of different employers with different circumstances. So really, I'll not go through this slide in detail. Again, it's just giving examples of different employers, different sectors, whether they're an academy, a council, a charity, just reflecting a really diverse group of employers with very different profiles in the LGPS and different needs. We do have a tool already that we use to tackle that diversity. So when we come along to the formal valuation, we set contributions for each and every employer in a way that is consistent with the target that they're trying to reach and is a way that's consistent with their participation in the fund. So we already use contribution strategy at individual employer level to make sure that they've got the best possible chance of achieving their objective. The tool that we apply more broadly across the board is the investment strategy. The investment strategy is set at whole fund level, so it's based on an average position for all the employers. And it works best for the employers who are most like that average position of the fund as the whole. And that's typically the large ones like the councils, who are most like the average position of the fund. So if we go through it, this is really just this slide reflecting the detail we do go into in setting the contributions. Just to remind you, this comes out of the funding strategy statement. And it really shows the level of detail that we go into in setting contributions for different types of employers and really tailoring the contribution strategy to help that employer manage its participation in the LGPS in the Hertfordshire Fund as cleanly and as in a way that's most manageable for them. So, some of the examples of that would be that we have stabilised contributions for large councils, but for shorter term bodies that's not appropriate. I've got a question, Chair. I'm happy to take questions as we go through, if that's okay with the Chair.
Adam.
Yeah, I mean, I'm quite happy to wait to the end. My question is, looking at the chart on Agenda Pack 38, that there's some quite big outliers in that list. And how do you, I suppose what I'm asking is, how do you disaggregate the impacts that the changes for those outliers is going to have on the strategy of the scheme overall? Because if you have a high number of sort of outliers, if you like, that is going to change the underlying structure of the strategy of the fund. So I'm just wondering how you can try and mitigate that. So
it probably become clearer as we get onto other slides, but the short answer to it is, generally speaking, the position of the fund as a whole is most like its large employers, and the outliers tend to be a very small proportion of the fund as a whole. So it goes to, yes, they might look very different from the average, but they're possibly less than a kind of 0.1% of the size of the fund. So that's the quick answer to that.
Okay, thank you.
So this is really just talking about the way the fund is just now, that we have multiple employers, but we follow one investment strategy. And it talks about the LGPS there. Slide maybe slightly out of date, because I would say probably about between 25% and a third of funds have started to tackle this as part of the 2016-2019 valuations, started to look at ways of moving from that one investment strategy for everybody into not individual strategies for every employer. I just want to make that really clear. What we're looking at doing here is identifying groups of employers, probably quite small groups of employers, where the core investment strategy, the main investment strategy, for whatever reason, isn't most suitable for them, or really isn't suitable for them, and identifying small groups for which, if we made a change, it would substantially improve their chances of reaching their funding objectives. So to the how question, how do we do it? Patrick mentioned the HEAT tool, the employer asset tracking tool that we use to track each individual employer's position in the fund, each individual employer's assets in the fund. And it's really, the way that it works is very much like a bank account. It's very notional. Investment return gets allocated alongside, and the cash in and out gets accounted for, and at the end of each month there's a statement for each employer. The way the different investment strategies might work is that we step back a little bit, and because we want to do this in a really pragmatic way and in a way that's manageable for the governance of the fund, we look at the strategy as a big picture, and we say, okay, we've got elements, mandates in the strategy that are about growth, some that are kind of mid-risk and some that are about protection, and we split the mandates up into these groups. And then what we can do in the HEAT asset tracker is allow employers to test whether having a different allocation from the whole fund into each of those groups gives them a substantially better return. So the two examples shown there are, if we reduced the asset allocation in growth for some employers, so instead of saying you have the exact same pattern of growth, mid-risk and protection as the whole fund allocation, we dial down your growth a bit and give you more protection assets. Does that, for example, give you a better chance of reaching your funding target? And examples of types of employers that might work for are those that are very well funded and very close to exit. So if they're in a very strong funding position and they're trying to leave the fund in the next year, 2 years, 3 years, they really don't want to risk the levels of volatility that are there. And so they might have a better chance of success, a better chance of reaching that end point in 2 years' time if they had less in growth assets. The other example, the other way round, is a kind of recovery strategy for very poorly funded employers. So as the fund has gone on its journey, and we see as a whole, the fund is now over 100% funded. And so you are proactively thinking about, as a fund, how to take less risk, because as a fund as a whole, you don't need that level of risk. There are a few employers which, for a variety of reasons, some of them are their own funding decisions, some of them have got to do with their timing of participation in the fund. They are not in that strong position. They are not over 100% funded. Some of them might have quite weak funding positions, and therefore, as we dial down the expected returns for the rest of the fund, or we go into strategies that may deliver lower returns for the rest of the fund, it's maybe more appropriate for them to stay in a growth type strategy. So those are just two examples, but those are the kind of typical things that we see. The potential benefits. These charts are actually, I've stolen these from another client who runs two strategies. They run they call it their current strategy, which is their main strategy for the vast majority of employers in the fund, where the objective of that strategy is actually about keeping contributions affordable. So fairly high risk, high volatility type strategy. But for most of those employers, they're in the fund for the long term, and they're, to a greater or lesser extent, relatively balance sheet agnostic. The alternative strategy that they implemented were for a group of employers for whom they're looking to exit in a relatively short time frame. They're closed employers looking to exit. And so for them, a reduced funding level volatility is their primary objective. They've got the funding level to broadly where they need it to be, and what they want to ensure is that it stays stable at that level. And you can see that the two different lines there showing the performance of the current strategy, which at the point that we've cut it off is actually underperformed the alternative strategy, but over time we would expect that volatility to be rewarded with extra returns. In terms of the process that we're following to do this, as I said, we've been through this with a number of funds now, so we've got quite a clear process that we follow. The first step, which we've already carried out, first two steps have been carried out, is to identify groups of similar employers based on the profile metrics, going right back to that first slide, the different types of profile metrics that we want to use to split the employers up into groups. And we've already completed that part of the exercise. And then also, because we want to, as I say, be pragmatic and have a manageable governance burden on this, is we've rationalised those groups down into a very small number to consider the strategies to model. From then on, what we'll do is we will test different strategies against those different groups of employers to see which ones are most effective for which groups. And really what we're looking at is to answer the question, are there some of those groups of employers for whom the main strategy is really not suitable? So not can we find a marginally better strategy for two individual employers. It's about groups where we could find a materially better strategy for them. We're not wanting to be kind of tinkering around the edges. As Patrick said at the start, it's really important that we have employer engagement with this and employer understanding, and so that's a really core part of it. And then the final stage of it is implementation. And typically some of the questions we get on this are what's the impact on the overall strategy? And hopefully this next slide will help answer that, because it's showing the kind of relative size and scale of the employers that we're looking at here. So this is the result of the initial work that we've done to split the employers into groups. So the main difference between Group A and the other groups is that Group A contain all the employers that are open. So those are all the employers who will participate in the fund for the foreseeable future. They haven't set a particular end date. They are still open to new entrants. And you'll see that covers probably 90% of the employers by size, actually 90% of the assets of the fund. So over kind of these are based on asset values at the last valuation. So, but 90% or more are in that Group A. Within Group A, we do have a variety in funding levels. So the kind of A+ to the A- is really about the funding level of them at the last valuation. But you can see that the vast majority of them will sit in that Group A, the open group. Group B are admitted bodies who will leave on an ongoing basis. So these are people who are planning to leave the fund, but they will leave the fund on a normal funding basis. Group C are people who are planning to leave the fund, but they will do so on a gilts basis. So they have no guarantor, and when they leave the fund, potentially the liabilities could fall on other employers if we don't ensure that there's enough money to pay those liabilities. So they have a different funding goal. And then the final group, called the orphan pool, are employers that have effectively already left the funds. That's liabilities that the fund has where there's not an employer to back it. So you can see there the relative size and scale of it. And really what we'd be talking about is quite a small portion of the fund getting a notionally different investment strategy. The other question is, if it's such a small portion, why would we bother? What's the kind of benefit in doing this if it's such a tiny portion of the fund? And you really, to understand that, you have to kind of flip it round slightly, in that it is a tiny portion of the fund as we look at it from the whole fund perspective. But for these employers, the potential difference in the investment strategy and the potential effect that that could have in their final position with the fund is absolutely material for them. It's really, it could be really significant for an individual employer. This slide here, sorry, there's another hand up. I'm again happy to be interrupted.
Yeah, Margaret, if you've got
sorry, it's just clarification. I wasn't quite sure what a scheduled body is. I obviously do understand what the schools, universities and colleges are. What are scheduled bodies?
A scheduled body is one, it really comes down to, it's on a schedule in the regulations. That's why it's called scheduled, and basically says, as a body, you have to offer the LGPS to all your members. So it's these employers that are for whom the LGPS is mandated, really.
So councils would count as probably the major proportion of those.
Exactly.
Is that right? Yeah.
Exactly that.
Thank you.
That.
Yeah.
Okay. So again, this just talks about the kind of the way that we look at the different investment strategies. I've kind of covered this slide already, in as much as that we just split the mandates down into the kind of high level job that they do. And again, this is about pragmatism and keeping it simple. When you look at it, there is a bit of having to be pragmatic in allocating them. There are different mandates there that could equally move between them. But again, this is about doing a better job for some employers, not getting it absolutely perfect for all 300. And so when we go through the next stage of this, the next piece of work that we will do is testing varieties of or variations in the strategy, the kind of variations that I've talked about. So more risk strategy or a less risk strategy, basically, against some of those groups of employers. And the results that we expect to see is that for that group A that comprises the vast majority of the fund, that the strategic target that you've got, that the current strategy is absolutely the right strategy for them, because it's been set largely based on a fund that looks like them. What we expect to see then is that for some employers who really don't look like the average position of the fund, either because they're closed and looking to exit, or because they've got a very different funding level from the average of the fund, for some of them, one of the other strategies might be a better option. And once we've completed that work, we'll bring it back to committee for further discussion. So that was really a quick run through that. I'm very happy to take questions.
Robin.
Yes, thanks. Thank you for that run through. I get the general idea, but I just wanted to clarify. And the idea basically is that the overall fund is our assets are allocated to the individual employers according to their needs. My question is this, really: what would happen if too many of our employers needed to be allocated the same sorts of assets? If too many of them wanted growth assets and not enough wanted protection, how would we actually do that? Wouldn't we, to put it simply, run out of the assets that people wanted to be allocated if if that was the case, if they all wanted the same thing?
Yes, that would happen in theory. In reality, the situation is, though, that the weight of the employers, so the size of the employers, the big employers, are what drive the investment strategy for the fund as a whole. So if you had if you were in that situation where you had more employers for whom it was really showing that you needed more protection assets, it would probably imply that the investment strategy for the fund as a whole wasn't aligned with the employers. And so it doesn't really happen, because what we've got is, for the big employers with the majority of assets, the investment strategy is aligned to their needs already. So the assets that are available are the ones that they need. it's really only the smaller employers that don't look like the fund as a whole that it would come down to. So if you did get into that situation where you were saying, oh, these employers desperately want more protection assets than the fund can afford to give them, it would probably imply that the fund as a whole needs to think about its overall strategy. So, it doesn't really happen that way.
Right. So this mainly affects only the smaller employers. Right.
Exactly.
Okay. And you can tinker about with what assets are allocated to them without affecting the overall fund, the overall envelope of fund. Yeah. Okay.
The only time that becomes a big issue is if rather than having one big employer in the fund like Hertfordshire Council, you could imagine a fund that had maybe two large employers that were maybe 40% of the fund each. And we have seen this in other places, that you have two big councils making up the fund, and for some reason the two councils look very different. So you could have one council you could imagine that's spectacularly well funded and one council that's really poorly funded. So the average position is very different from both main employers in the fund, and that's when you might start to see a bit of a strain on this central strategy. But for a fund like yours and the work that we've done already, if I look at that group A of employers, you can see that 90 to 95% of the assets of the fund belong to those employers that are already in that group A, which is what the strategy is already optimised for.
Right, thank you.
Catherine, I've got a question regarding the situation with small employers who are identified as requiring a more aggressive policy and who will need to understand what the transition from the general position to a more aggressive policy might mean for them, because more aggression means more volatility, and more volatility means you might go down rather than go up. And I'm just concerned that some employers who may only be in for the short term rather than the longer term may choose that aggressive policy in the knowledge that it might go down rather than go up, merely because it relieves them of the requirement to make appropriate contributions to support the staff that they are employing. I'm just concerned that overall that might give the smaller employer an incentive to be aggressive when it's not necessarily in the best interest of their employees.
That's a really valid concern. Just now, the fund decides the investment strategy for all the employers, and that this work doesn't propose to change that. So what we would do is we look at what we think is the best investment strategy for an employer that gives them the best chance of meeting their objectives. And part of their objectives are to ensure that there's enough money in the fund. So it may well be that they are not terribly well funded, but it might be better that that gap is made up through contributions, not investment strategy, in order to protect their participation. But what this gives us is the ability to use both tools together to maximise that chance of success. So the fund will retain that decision.
Okay, so the employer will be asked whether, for instance, we think you need to go into a more aggressive position here because that's going to be in the best interests of you and your employees, and presumably they would have to agree to that. But what they can't do is turn around and say, "Can I have an even more aggressive policy? Because that means I'm going to pay in less in contributions." And the fund might say, "No, we don't think that's appropriate."
Exactly that. That's a really good characterisation of it. We want it to be a dialogue. We want it to be a bit that says, you know, we've looked at this. This is what we think is the best strategy for you. And hopefully they'll engage in that and want to go along with it. But you're absolutely right. We don't want employers taking more risk than we as a fund are comfortable with them taking in order to pay lower contributions.
Margaret.
Would you mind just going back to the last slide, because I'm not sure I've quite understood it. Are they dates going across the
Which one?
top?
This one here?
No, the one previously, your last slide in your presentation.
I can do.
And then sort of
this one here, right? No, yes. Sorry, they weren't dates. They were asset allocations. So if I look at that 65-23, so we have our strategic target, and when we characterise that as growth, mid-risk and protection, it splits down to 57% in growth, 23% in mid-risk and 20% in protection. Now, there are other ways you could cut that, but that's one characterisation of it. When we test other strategies with the employers, so if I take the column alongside that, the one titled 65, 23, 12, what we've done in that is we've reduced the protection assets and dialed up the growth assets. So that would be one of those strategies that we would consider as higher risk, more aggressive, as was characterised before. And then as you move from the left to the right, the strategies after that become less aggressive and more defensive. So you can see in that one 40, 23, 37, we've shifted 25% out of growth into protection, or we've allocated that employer 25% less growth and 25% more protection. So that will give quite a different expected investment performance. But what it may be sufficient for some employers that are already very well funded and just want to stay there for the next year or two before exiting. It absolutely wouldn't be sufficient, for example, for one of the councils, because it would massively increase the burden they need to pay in contribution rates over the long term. So it wouldn't work for them, but it might work for an employer that's already very well funded, who's only there for a year or two. Is that clearer now? Sorry, I did skip over it a bit.
Yeah, except that, how do you know this is going to work? I was going to say, are you doing sort of sensitivity analysis? You're going to try that particular division of the funds, and then see if it's doing what you really want it to do, because obviously you've got different variables going on. How many people are actively employed and actually using the fund? Actually employers behaving well. You've got different variables going on, and I just wondered how you've sort of picked your strategic targets to start with. I mean, obviously you got what they were on that date or whatever it was. When so you've analysed the fund, and that's what they are at the moment.
Yeah.
And you're aiming at getting them better, and getting the allocation to behave well. But I'm just wondering, how do you know that's going to happen? Okay.
When we do the analysis, we'll bring it back. You're right. I probably skipped over it in that way that you do when it's not you that's actually doing the work. It's the team back at the office doing the work. But it's a really sophisticated piece of modelling. And what we do is we take the employer's projected cash flows. So we say these are all the cash flows that we think are going to happen from that employer, making, and there's assumptions built into that, but things that say, so, these people will be in the fund for this length of time and then they'll retire. So this is the cash flow profile of the employer. And then we test it against a model that says, if you were invested like this and we project forward into the future for 20 years, where would you be? And we can cut slices wherever we want. We can cut slices, say, if you're invested like this, where do we think we'll be in 2 years' time? Where do you think you'll be in 5 years' time? And we can compare those outcomes at the different time horizons for the different strategies for the different groups of employers. And that's the piece of work that we're about to undertake.
Okay, so you are sort of like doing a sensitivity analysis over the next year. Is it how long have you given yourself to do this?
To do the piece of work, it only takes a few weeks to do it because it's done through a model. So we don't need to wait for the conditions to emerge. We run multiple scenarios through the model. So it will take us a few weeks to do the modelling, and then we'll be able to bring it back and say, this is what happens next.
Thank you for explaining. Yeah, thank you.
Okay, I don't see any other questions, and the recommendation in the order paper is that the Pension Committee notes the comments on the content of the Hyman's report. Could I just ask you to therefore indicate in the chat line that you agree with the recommendation, please? I think we're going to be pretty certain to get that, so I'm going to move on. That's agreed. The next item is to move into part 2, And given that we've been going for an hour and 15 minutes, I think this is an appropriate point to just take a short break. And when we come back, we will be in part 2. So I'm going to ask people to return at 11:25. That gives us 10 minutes to stretch our legs and do what we need to do. At 11:25, we'll start part 2. Can I confirm with the admin team that they'll take us offline now?
Hi, Ralph. Yes, the live stream's just paused for you now.
Okay, thank you, guys. If you just leave your phone, your camera and a microphone off, then we'll restart at 11:20.